The markets, we're joined now by Bryden Teich. He's a partner and portfolio manager at Avenue Investment Management. Nice to see you, Bryden.
Good to see you, too.
Does it surprise you that at least sort of measured through the S&P 500, we're talking about records for the stock market?
Definitely not compared, relative to how we ended the year. It seems like we've been on this train now since the lows in October. And to generate a new high in the index is a significant thing. I think what's interesting now is you touch on the Bank of Canada. I think the Fed is next week. And I think a lot of that rally from October and November was based on the expectations, as you said, for rate cuts. Some of the comments in the last week or two seem to have walked the immediacy of that back. Sounds like rate cuts are coming sometime this year, but maybe likely into the middle of the year, would be our guess. But for now, the fact that we've made a new high, I think, is significant and of noteworthy.
What do you make of that idea that, okay, even if the economy has challenges, the idea that the rate cuts have already been discussed in the market by central banks, that's a cushion of sorts. Would you buy into that thinking?
Well, I guess I would say the market at new highs has already priced in the expectation of a certain amount of cuts this year.
Okay.
So now you could say, if cuts don't happen, then the market has to adjust. Or if cuts happen for the wrong reasons, that will likely be as part of some adjustment process. So I think, a lot of these things will get, they disseminate what their views are, the Fed, the market prices it in, then we sort of wait to see if they change their mind, and then the market has to reprice that. And that's kind of what the game that's played, the inside baseball day to day. But I think to your point that you highlighted off the top, like if we don't enter recession and earnings are okay, and we kind of have a benign view on rates for the next 6 months, there's no reason why the market can't keep pushing higher.
I don't have the Canadian stats at my fingertips, but we had a guest recently who noted that historically, when you're in this period before there's actually rate cut, kind of when you're in sort of the pause mode, it's actually historically not a bad time for equities anyway.
Oh, no, I would say it's exactly, it would be, this is the last gasp of non-recessionary, benign economic growth with rates starting to come down, which is, if you don't have a recession and earnings aren't going to fall, and you have lower rates, that's as good of an environment for equities as you could posit. It's just, do we get to a point where rate hikes come because of bad things? And generally, the cutting cycle is actually not a bullish time for equities. The pre-cutting is always bullish, is what you just said.
So it's interesting, and to your point, there's like all these levers. People are worried about if the economy deteriorates, what does that mean for the jobs market? And then does that mean more economic weakness? For companies, though, generally speaking, they are rewarded for controlling costs. Even the big technology companies have been paring their employment levels so far this year. And so I guess the story of earnings factors into whether a stock is a fair value or a less than fair value because, profit is a measure of a stock's valuation. Mm-hmm. How do you feel broadly about the earnings picture right now?
I think as long as nominal top-line growth in the economy stays in the range that it's been in, I think there's no reason to expect overall earnings levels to decline. I think what's interesting, and we've had to go back and evaluate this, but the 70s was perceived as this high inflationary decade, which people have negative memories of the economy. The 70s were actually a great decade for S&P earnings, because if you have nominal growth in your economy, it's a huge boost to earnings. And so that's where I think we were all looking and expecting a decline in earnings last year on the back of a slowing economy, and it didn't happen. And I think that if we stay in an environment where we have this continued push from fiscal spending, I think a material decline in earnings, I think, is something that might not materialize like it has in past recessions, because there's this lingering effect of all the stimulus. The question, though, I think the bigger picture right now is what do rates do? And I think a lot of the wobble we had in 2022 was obviously the surge in interest rates. And so if we can get some pressure off of interest rates, even a cut here or there, non-recessionary cuts, I think there's no reason why the equity market can't keep pushing higher.
Now, I like to talk about the makeup of indexes a lot, but I think that in a world where people buy a market, buy an ETF. I think it is important. The S&P 500's main technology subgroup is about 30% of that index, and then that doesn't even capture some of the other big technology companies that might slip into another subgroup, communications or discretionary. So tech is a huge part of that S&P 500 rally. The TSX, I think the tech index is less than 10% of the index. So
that's probably all Constellation and software and Shopify.
Yeah. Exactly. So I would assume some combination of banks and energy and material stocks has to do relatively well for the TSX to stay competitive with the S&P 500. I know you're a stock picker, but how do you feel about the makeup of the Canadian market versus the U.S. market?
Yeah, I think it's just if you were a pure index investor, there's a perpetual limitation to the TSX as an index because it is has such a cyclical component, which 2022 was great because you had commodities and energy doing really well, and the financials did okay. Obviously, last year, we're a year where tech rips. Canada is not going to participate in that. I think, what we try to do is we're benign on whether we're looking at the U.S. or Canada. We're looking for what we think are the best companies that can generate earnings over and above sort of the average in the index. And then can we pay a reasonable price or a market multiple on that? And there's a lot of great compounders hiding sort of in plain sight, but they're not regular things that would be large components of an index. So that's kind of where we make our hay, is trying to find nuggets that we think are better than the averages, but are not necessarily discounted, because if you're an indexer, you can't buy those kind of things.
That's a